Candlestick charts are widely used in intraday trading to analyze price movements and make trading decisions. Here are some steps on how to use candlestick charts in intraday trading. Select a time frame. In intraday trading, you typically focus on shorter time frames like 1 minute, 5 minute, or 15-minute charts. Choose a time frame that suits your trading style and preferences. Understand the candlestick components. Each candlestick represents a specific time period and consists of 4 main components: the opening price, closing price, highest price, high, and lowest price, low, during that period. The body of the candlestick represents the price range between the opening and closing prices, while the wicks, also called shadows, show the range between the high and low prices. Learn candlestick patterns. Candlestick patterns are formed by the arrangement of multiple candlesticks and can provide valuable insights into potential market reversals or continuation of trends. Some common candlestick patterns include doji, hammer, shooting star, engulfing patterns, and harami. Study these patterns and their interpretations to identify potential trading opportunities. Identify support and resistance levels. Support and resistance levels are areas on the chart where the price tends to find buying support or selling pressure, respectively. Candlestick patterns can help you identify these levels. For example, a reversal pattern forming at a resistance level may indicate a potential trend reversal. Use indicators and confirmations. Combine candlestick analysis with technical indicators or other forms of analysis to strengthen your trading decisions. Indicators like moving averages, oscillators, or volume can provide additional confirmation or signals to support your candlestick analysis. Set entry and exit points. Once you have identified a potential trading opportunity based on candlestick patterns and other analysis, determine your entry and exit points. This includes setting stop-loss orders to limit potential losses and profit targets to secure your gains. Practice risk management. Intraday trading can be volatile, so it's crucial to implement proper risk management strategies. This may involve limiting your position size, setting strict stop-loss levels, and avoiding overtrading. Backtest and refine your strategy. As with any trading strategy, it's important to backtest your approach using historical data to evaluate its effectiveness. Analyze your trades, learn from your successes and failures, and make adjustments to improve your strategy over time. Remember that candlestick analysis should not be used in isolation. It is essential to consider other factors such as market conditions, news events, and overall trend analysis to make informed trading decisions. Continuous learning, practice, and experience are key to mastering the art of using candlestick charts effectively in intraday trading.